Trading the bear market rally using seasonality into 2023. Ron Williams, the FSC Development Director. I'm excited and always honored to be delivering insights on behalf of the Foundation Study of Cycles. So a brief background to my professional experience, all there up on the screen and of course on our website, but as a preamble, it's plus 20 years experience working for leading economic research institutional firms, producing tactical and trading strategies. The approach is global multi-asset top-down framework grounded in behavioral technical analysis driven by cycles based on the roadmap signature model of veteran market technician Robin Griffiths. I'll let you reflect on the rest post-session. Now, the synopsis for this presentation is, of course, in line with our seasonality headline theme. And the preamble here is that the US equity markets just passed this October of 2022 triggered one of the largest one-month surges in over 40 years. And of course, that was part of an oversold significant reaction that happened in markets. We saw it more in the US on the Dow Jones index, more specifically, with the other indices that followed thereafter. The question is how to trade this bear market rally, which is what it seems to continue to be, according to my analysis, using technicals, seasonality, and cycle patterns. Most notably, two things I'll talk about: the post-Halloween effect, which is what happens after the autumn-fall crash pattern, and this year, most important to other years, the midterm presidential cycle. Every 4 years, we have the presidential election in the US, and the midpoint of that election cycle is the best performing one and one of the most important stages. So this double or even triple whammy effect signals further support, perhaps upside, in risk markets and the stock market for the first quarter of next year, 2023. Now, the long-term bottom line is that a structural market fall is expected still, so the worst ahead before it gets better, based on the roadmap model framework, which I continue to use and share with FSC audience members. That will, of course, unhinge further legacy macro headwinds. Many experts talking about a slowdown in the economy, which might lead to recession, and of course, a hit on earnings and perhaps even labor in terms of the employment lagging indications. Now, the key topics in section staged framing is the roadmap model, seasonality, what and why in terms of what is it, but also why should it matter to us. The best seasonality signal known, which is the best 6 months or BSM, where some good monetary gains can be made. And then a segue into the additional positive seasonality pattern of the midterm elections, which I've framed as portfolio and politics, how all of this can and has led to a bear market rally average of up to 23%, which is what we usually see in a big bear market structure. And ultimately, at the very end of this, the worst ahead, with capitulation still to come, a long-term decline from Q2 second half of next year, going into another year or so before the spring can follow the winter season with a new bull market opportunity. Now, for those of you who are keen to follow this work in your own time, we have a wonderful and active FSC blog on the website. These are the articles that I've written which are related to the presentation that I'm sharing with you. So look up the new blog that will be coming out soon, themed Portfolio and Politics, all about the midterms and what that means for markets. the Halloween effect, which is already online, trick or treat, in terms of does the signal work or not. And then seasonality, danger zone ahead. That was back in summer just past of this year, beginning the whole seasonality theme for all our audience members. And then just lastly, big picture question on is the big cycle turning, which features a lot of the roadmap cycle framework that will share now and have shared before. Okay, so what is the roadmap model? Essentially, it's a triad process, starting with a blended approach of macro fundamentals and technicals. That's the main triad blend and edge that is led by behavioral technical analysis and a blend of quantitative and qualitative models. Timing is key, and so that is the driver behind the process, looking at a roadmap model, which is basically a composite cycle framework, including the business cycle and seasonality patterns, which is prominent for this discussion. And then lastly, for the actionable strategies, trend ranking models that look at global cross assets, on the equity side, sectors and stocks, and all other markets that trend. The roadmap boom bust cycle averages 10 years, but there are fractal variations of it. The skew is typically asymmetric, and you can see here the mountain rise up and the cliff drop down. That's part of the greed and fear pendulum swing. And right here and now, it suggests that we are in the late cycle between W, X, and Y. And the behavioral price pattern behind that is a fall, rally, and rest of fall. So that second stage from fall to rally is the bear market rally, which we have experienced year to date in 2022. And what we have ahead, based on high probabilities, is the rest of the fall capitulation phase to go. Now, it won't be a straight line down or even sideways. It'll be a variation, and certainly something that we should position for in terms of a negative scenario. Now, just a quick point on the right side of the slide, it just shows that there is no one size fits all cycles. All cycle specialists, especially at the FSC, will know that through experience, and many of the theoretical books. So the normal cycle is just here on top, the bear cycle and the bull cycle, each with a unique skew according to that market regime. Now, the blended triad approach, remember, is a mix of macro, fundamental, and technical. Macro for big picture, fundamental for valuations, and technical for the price internals. If we frame that up into a watch list rotational system, you can see here on the right, we have three factors: macro growth, valuation, fundamentals, and technical internals, all as part of a checklist process, suggesting that we are in the late cycle, again, as was just mentioned before. But here we have more of the granular detail showing that macro growth in the US is falling post-peak. It's also true for Europe and UK and other parts of the world, but US is the proxy here. Fundamental valuation based on greed and fear mixes. Greed is starting to unwind. We can see that in the growth rotation back into value. Tech stocks as a case in point, and technicals are starting to look at a bit fragile. Certainly right now, if you're looking at the live screens, the US equity markets, S&P 500 as a case in point, is unwinding from its long-term falling 200-day moving average, and we can see a further unwind in risk on going into year end. And of course, there are many other signals that can confirm that. Now, the bottom half of this screen just shows the so what actionable analysis in terms of asset allocation. What do we do with the portfolio or the trade? It basically suggests defense is the best way to deal with a elevated, volatile bear market. So typically cash, long duration government bonds, and if we're thinking cross-asset, gold and the dollar, or if the dollar king has potentially rocked and rolled and is likely to unwind as it already has so far, then maybe other safe haven currencies like the Japanese yen or Swiss franc. But it's the mixture of defense, which is the best positioning for capital preservation in order to then have enough powder to reposition for better opportunities ahead. Now, the cycle framework, which is most important to this discussion, is ranked from big to small. There's one that I haven't actually added onto here, which measures global sentiment, and that has been negative ahead of time into 2020, signaling that 2020 and the years thereafter, including this year and next, were going to be worse than the 2008 global financial crisis. So it was a heads-up signal of winter ahead. The economic cycles that most of us will know about are the Kondratiev wave cycle, just up top, averaging 54 years. That influences interest rates and inflation and just general societal sentiment. Juggler cycle, which is known as the boom-bust economic cycle, averaging 10 years. The Kitchen cycle, which is the former British cycle that later on got associated with the US 4-year presidential cycle. And then right at the bottom, the seasonality cycle, which many of you will know in the equity market space, in examples like sell and may go away, when volume is low and volatility is high, but also it's true for cross assets. The dollar tends to be negative in December and positive in Jan due to tax repatriation. The gold tends to be positive towards the end of the year due to greater demand. So there's a nice mix of seasonality patterns, which are good for tactical opportunities across most of the key markets that you can imagine. Now, all of these cycles are adapted cycle schema based on the roadmap signature work of mentor Robin Griffiths. These cycles primarily influence global sentiment, policy, and markets. And each cycle is unique, but here's the key: when aligned, create a tidal wave effect and a so-called crisis opportunity, which is the setup and the technical positioning that we can benefit from. Most important question: seasonality, what and why? This will be a big feature of the FSC educational work that'll be set to launch in the new year of 2023. And of course, we always want to begin by asking the question, what? Seasonality is a regular and predictable pattern that recurs every calendar year. Every industry exhibits unique seasonal trends based on solid drivers. The best known seasonal drivers, as I had just mentioned, includes the harvest periods. Jake Bernstein would have mentioned this in terms of his soft commodity analysis, but also our head of science, Ray Terms, also spoke about the causality of this in terms of the natural driving factors, the timing of interest rate payments in terms of economic factors, tax or balance sheet deadlines, earning reports, if we're thinking about stocks, the weather, investor sentiment, of course, being the heartbeat of markets at certain times of the year, and how that pendulum swings from one season to the next, as well as traditional patterns such as the one that we are likely in now, the year-end rally in the stock market, which isn't performing as expected, but still it is a pattern that is reliable over time. One of the most popular seasonal patterns in the equity market is sell in May and go away, based on summer volatility, which I mentioned, and low volume. It's not necessarily the most reliable, but certainly one of the more popular ones. And I believe one of the reasons why it's not as reliable is because it's misunderstood. And as you can just see in this hedge eye cartoon, two trader veterans looking at each other, one saying sell in May and go away, the other one saying, nah, don't believe you. But this year, actually, it did work. And it was proven in the actual market action we had one of the worst performing years this year, but especially from the May period onwards, there was a significant move to the downside, and a lot of seasonality trends moved back into beat and pattern. Now, the big reason why seasonality matters is really building on the point that Jake Bernstein highlighted several times. This market timing technique can help drive bottom line performance. So in simple terms, you can make more money by understanding seasonality, but not for the reasons that you might think. You can make more money by using seasonality because it will allow you to market time the worst days in the market. And so according to this research from Goldman Sachs, but it's echoed by many other platforms out there, if you were to just invest in the market and do one of three things, the best performing strategy of the three will be if you got out or at least managed your risk during the worst times. And in this case, the example is the 10 worst days. So market timing, worst 10 days in the stock market significantly boosts bottom line performance. Now, in the wise words of the US investor Warren Buffett, he has a rule called Noah's Rule, referencing the biblical text of Noah and his smart ark. Predicting rain doesn't count. Building arcs does. So that's highlighting the point that capital preservation and risk management is ultimately top over a so-called edge or any way that we can enhance our performance. But perhaps the best strategy, if possible, is blending both prudent risk management and unique alpha capture. So predicting markets and or rain or any kind of shock event, it is still useful, or even an opportunity ahead. But ultimately, the name of the game, if you were to choose, or at least make sure that you had one over the others, is definitely going to be market timing the worst moments in the market. And so seasonality helps. One clear example of that is the sell-in-May pattern, and specifically the September-October period, which is well known for having significant drawdown periods. And so instead of just buying and holding, as you can see here in the center, we can time in and out or manage our risk in a more prudent way. Now, the seasonality pattern can be seen, and I'm a big believer of seeing is believing. So if you backtest the price data going back over 100 plus years, looking at the Dow Jones Index, you will get these stats. And it shows that January is often a barometer as the year starts. So is it an indicator for how the year performs and ends? This year was a unique case in point. January started as the most volatile month since the 2008 global financial crisis. That's according to the peak to trough drawdown in Jan. That, of course, also correctly predicted the year-end performance. But if we then progress to the next step, April, which is where the real pattern begins, that's often a Q2 climax fueled by earnings seasons, followed by the sell-in May or SIM negative seasonality, pressured by low summer volumes and elevated volatility. And stage one, in terms of the downside risk or the biggest drawdown, is in June, not May. So we say sell-in May as an early indication of positioning, but the real risk that we need to hedge is the month that follows. And thereafter, that oversold condition creates a mean reversion upside relief rally into what we call the midsummer rally. And that's typically between July and August. Now, that's important because it gives the market a temporary breath or a sigh of relief to then lead in during the positive summer months, I might add. So that probably adds to the positive sentiment to stage two of the drawdown effect, which is the biggest of the two in September, not October. And September is marked by a false low, followed by a real low in October. We remember October more than September because that is typically the anniversary of a market fall or crash. Think of 1987 as a popular example. Now, the sell-in May pattern does not end with sell in May. The second half of that, if you go back into the historical books in the UK, is to come back in time for St. Leger's Day, which is the British racing season from some time ago. And that's from November onwards as part of what we now know as a year-end rally, which continues into the new year. Now, the sell in May seasonality pattern, just a few insights here that should hopefully be useful for everyone. What actually happened this year? So remember we said that the worst drawdown effect starts in June and then follows in September. Well, this year, June 2022, returns were the lowest in history as compared to the 2008 global financial crisis and 1962 Kennedy slide. So for one, it was a negative outlier, and that gives us a good technical context in terms of what may follow. The other point is that the historical rhyme of a blend of two of these unique event risks offer kind of useful analogies in terms of the market shock, which we did experience and may still continue, and of course the geopolitical tensions certainly of the 1962, where we had the Cuban Missile Crisis. So the whole Russia-Ukraine historical rhyme also chimes on that point. History sometimes has that echo effect. From a market perspective, this also signals increased probability of a sizable oversold reaction, or as my analysis is suggesting, a bear market rally. And the actionable and profitable trade signal is truly achieved once we include a viable technical setup and a follow-up. Recall what Jake Bernstein had said about the trade being pattern setup and follow through. So of course you do need a robust process that leads to the trade execution, and that did prove true. I mean, it can always prove true for seasonality, but particularly this year, if you had looked at some of the reversal signals in that period and thereafter, they were clear and profitable. Now, some wise insights from a well-known name, Michael Burry, from the real story behind the Big Short prediction from 2008, which you can watch now online. Michael Burry of the Big Short reminds us that the largest bear market rallies, but also one-day rallies, typically occur during a bear market crash. So even ahead of the crash, usually these are the early characteristics. Notable examples include Y2K bubble burst and the Great Crash of 1929, but you can also add 2008 there if you look at the pattern of the bear market rally, not just the one-day move itself. The average is plus 23%, and this can happen on multiple times, or you can get variations of that price magnitude. Either way, it is a tactical money-making opportunity if you're nimble and able to get in and, more importantly, out to lock in those profits. Now, what happened if we just focus on the summer segment of the market move, we can see here that it did actually near 20%. That's the mid-bear market rally here. You can see that everything beyond the intersection of Jan this year onwards was when the equity market and risk on shifted from bull to bear after it crossed below the long-term, now falling 200-day moving average, which is a strategic signal. So the bear market rally phenomena happened several times, 1, 2, 3, 4, 5, but the biggest one was in summer, in line with the typical seasonality expectations during the midsummer rally. And the market context is key. The fact that the 3 bear market rallies all failed under their falling 200-day moving average, the red line on the screen. The October low at 34.90 is the key reassessment level, and you can see at time of this recording, the market is falling, having failed on the back of a 5-wave mini bear market rally trend. Now, the autumn fall crash pattern, which is then follows and brings us a little bit more up to date to our event now, is a setup led by the midsummer rally in July. So that and this is the more reliable and certainly popular one that people remember. Now, the chart that you see here on the left is a backtest of the last 100 years of history on the US equity market, and it shows the average seasonal pattern during the negative period of the peak drawdown between September and October. It begins with the setup by midsummer rally in July, which leads to an overbought peak out zone between late August and then early September. It's usually one or the other, or a mix, depending on the type of top signal. What is more reliable and actionable is the drawdown in September, marked by a false low, followed by a real low in October. You can see this is the false low and the true low in October. And the reason why we remember October more than September is because, of course, that is the anniversary month of the extreme low of a market fall or crash, 1987 being a popular case in point. Now, interestingly, how do we, are all Septembers measured equally? And the answer is no. September can be worse than expected if things are already bad going into it. And so this is a nice technical milestone chart sharing with you what happens in September's according to different market conditions. So whether we're above the 200-day moving average, whether we're below it, or whether year-to-date performance is sub 15%. So we actually ticked those two last boxes, and that suggested that things were going to be worse than expected, just because markets were hard down for so long. So 2022 negative performance is a strong case example that led to a worse performing September, and we can use this not just as a past after the fact learning, but obviously we can use it in the future. And this is something I did use myself with clients as part of advisory report, but also positioning heads up to help clients manage that risk or even profit from it if they were able to position. Now, the Halloween effect is another name given to the same pattern. It ties in with the Halloween mythology of basically commemorating the dead. It serves as a useful metaphor of the investor behavioral realities for mourning and overcoming portfolio loss. That's my own behavioral thinking there, not least during the market carnage performance of 2022. In financial market, Halloween's late October timing coincides with the aftermath of the infamous fall crash pattern, which typically fuels a relief rally from oversold conditions thereafter. And that's what we saw in the final 2 weeks of October, the oversold reaction that led to the latest bear market rally, which is now rolling over. Typically, the worst drawdowns occur in September. We just discussed that, as it did this year, marked by a false low, which then follows by a true low in October. And thereafter, October is often remembered as the big month for these big down moves. Now, what's interesting, if you want to have additional action points, the seasonality pattern drawdown impact, it triggers Halloween effect in the last 2 weeks of October. So that's kind of the microcosm of the signal. It's kind of like the phoenix rising from the ashes. Things get so bad, markets fall down so much that in the end they act like an elastic band effect, and they bounce up from oversold conditions. So what you're seeing here on the top left hand or the top chart is the worst of the fall in October, which completes the pattern, is in the third week on average. And the last week is usually when we get what is called a positive Halloween setup, which of course we can position for short-term tactical opportunities. Intra-month analysis shows that is the sweet spot period, and the upside reversal often signals, chart at the bottom there, a temporary or final end to the bear market, which thereafter leads to what we refer to as the best 6 months BSM of market performance. Now, so you can see that last point in action and understand why it matters the most, this is it. And according to peer-reviewed academic research, the dashed line, which shows you if you market time the Halloween effect and basically get in last week of October all the way up until April, that's what it's measuring, then you will make significantly more performance over and above a buy and hold strategy, which many of us are by default in if we have a pension or if we are traditional investors with traditional strategies. So it just shows that we don't have to pick the tops and the bottoms, but if we just at least identify the best performing periods, the best 6-month period, which we are currently in now, then we can do better than most. That will work to different degrees because, as I'm about to share with you, different market conditions produce different types of results. So I believe that this will happen into the new year, but to a lesser degree because we're already in a bear market structure. Now, a quick segue into portfolio and politics, just to add that double whammy effect. So we looked at the seasonality patterns in general, specifically the sell in May, go away, and then the autumn fall crash, which leads into a Halloween effect. And now that is all supplemented by what I call portfolio and politics, and specifically the presidential election cycle and the midterm pattern that we have just started. Now, the presidential election cycle is a 4-year pattern, originally associated with a British cycle called the kitchen wave, but for decades now, it's been beating to the US political drum, and the midterm elections historically bring stock market outperformance in the subsequent 12 months with an average S&P 500 return of about 16.3% return, with variations in either a bull or bear market cycle. And that's the point I was just mentioning, and we'll follow up with using a visual chart for added reference. Jeremy Grantham, a well-known US fund manager, offers a subtle explanation that investors unconsciously believe. If anything were to happen to derail the stock market in a run-up to an election, the administration and perhaps also the Federal Reserve would step in with the appropriate measures. And so that uplift in policy in order to appease voters to get voted back in for a second term is part of the reasoning as to why markets tend to be positive during that point in time. Now, according to this research from Ned Davis Research, they've actually mapped out the probable trajectory, and it just shows here that 2023 is likely to be very positive. Now, I believe that it, as you heard me mention, it will likely receive support or positive seasonality performance, but to a lower degree. So my opinion is more bearish than this one on the chart analysis that I'm sharing with you. Part of the reason is because of this example here. Bad times are bad. A case in point is that the last time the S&P 500 produced negative returns for the 12 months after a midterm election was 1939. And you can see that's the top chart here. And we have the Wall Street crash, 1929, the Great Depression, which took us into 1939. And of course, that was a time of tremendous economic contraction, uncertainty, as the US battled the Great Depression, as well as World War II beginning in Europe. So again, a pattern of both market shock and geopolitical escalation. This also explains why negative pre-midterm market returns were dominated during the 1960s and 70s, pulling down the overall pre-midterm average. And this is why I'm a fan of using a combination of qualitative and quantitative measures, because if we just number crunch and we don't understand the context, things can be not only misconceived, but ultimately it'll lead to behavioral bias, misplaced expectations, and a whole lot of unnecessary portfolio loss. So we shouldn't believe that the map or the model is reality. It just gives us one piece of the puzzle And there are many other pieces that we need to uncover if we are patient to understand the context as well as the statistical numbers. Key point there, I hope you can all note that down. It's probably an obvious point to make, but it's one that is often overlooked. The tenors of Presidents Lyndon Johnson and Jimmy Carter were marked by stagflation, elevated policy uncertainty, and geopolitical tension. What's in store for Biden in his remaining term, time will tell. But according to most polls out there, the sentiment is mixed, not least because of the overspend, which of course is inflationary, and some of the taxation pain points, which is becoming an issue around the world. Now, there is no one size fits all. And if we look at the best performing part of the 4-year presidential cycle, trend context matters. And then that's what I was just echoing on the previous slide in terms of the worst during the 1920s and 30s, when we had the Wall Street crash and the Great Depression and World War battles. Here we have in green the bull market skew, what happens when there's a bull market ahead of the presidential midterm. Things are better than we expect. The average is the average, which is still positive, but mildly. And the bear market can actually lead to a bearish skew where it underperforms just because we get more of the same linear extrapolation, not in a straight line, but certainly we get the zigzags pushing down. Now, the likelihood is the red line on the screen. This is what I think will be more in line with what we will see from the midterm if we just look at it in isolation. Now, if we just focus on the average, which is this middle line here, if we just use this average, which is what most industry firms do just as a standard default, then the projection is marginally positive. If you use the average from 62 to 2018 based on S&P 500, you'll get this dark blue line, which could be positive for an additional reason, not just because it's the midterm, but because of gridlock. So with polls showing that Democrats could suffer from the so-called midterm curse, that's another part of the midterm signal, whereby the incumbent parties are fated to lose seats because of the second time around, so they have less firepower, and because perhaps the voters have seen them in their least best environment, especially if there are macro headwinds. You can see here that if they lose seats either in the US House or Senate, then they lose more policy power. So here, this would ultimately stall any major legislation. This is what it suggests, and frustrate any desired splurge in spending, while likely positive in the short term, because of course it would perhaps ease some of the inflationary pressures. It would also lead to greater uncertainty later on. But in the short term, there tends to be a relief rally because of this reason. And certainly that there has been a gridlock effect post-midterm results. Now, the actual shape of the cycle that I have come up with based on my own analysis and testing is this. So it's very different to the one I shared with you from Ned Davis and other portals out there. This is another probabilistic map, and it does still show a positive upswing into year end. But the difference is we get more of a typical behavioral fractal pattern where the market tends to zigzag in a volatile new year path, followed by a bearish sideways trend. So there's the volatility into new year with a potential drawdown, bear sideways, again with ongoing volatility, and then most likely a sharp autumn fall crash in 2023. Now, we can only really increase the odds in this being in line with reality closer to the time, but this does give a good heads up on what to expect once we match it up with the price patterns Remember, it's the pattern, the follow through, and the pattern, the setup, and the follow through. So we still need to apply technical analysis and market context onto this, with potentially a year-end rally next year. But again, not only do we need to wait closer to the time and match it up with market context and technicals, we also need to add other cycles to the mix. This is only looking at presidential cycle, and certainly in my multiple cycle framework, you're likely going to get different time skews. Okay, and then just to wrap up, here and now, there's still short-term risk-on opportunities, which are admittedly unwinding. This is a global ranking model just showing how we've had a rotation, US dollar interim top fueled by softer inflation, and the US 10-year yield correction, which is now starting to unwind from oversold conditions. But commodity proxies such as copper and gold are still bid, gold more. And Asia still leading the way with India outperforming, but overbought, and the US and Europe unwinding their bear market rallies. Gold is actually holding at key support. Silver seems to be a better proxy, high beta, but also more attractive risk reward. And everything else there is on the slide for you to read on the post video archive. Now, the 2022 bear market rally is this chart here, just showing that market context remains to be key. There were 3 big bear market rallies, all failing under the falling 200-day moving average. And this is literally the price action just passed into the rollout of our seasonality event with foundation study of cycles. So we are rolling over from that 5-wave impulsive bear market rally. The October low is at 34.90, will be the key reassessment level. There are multiple plausible scenarios ahead. It's not one. Base case scenario, we continued to go bear sideways with elevated volatility into the new year. Bear scenario that we retest the lows at 34.90 and either make or break. And of course, bull scenario, we retest the 200-day moving average and edge higher and maybe behave in a more positive way versus what we've seen year to date. Remember that if you look at other proxies in the US equity markets like the Dow Jones, it did break the 200-day and it did extend more than 20 or so %. But if we just use the S&P 500 as a broad-based measure, it's still giving you typical bearish market characteristics. Now, the grand finale of this presentation on trading the bear market rally into the new year of 2023 has the punchline right here in terms of repositioning for the long-term decline ahead from Q2 and second half of 2023. One of the reasons for that is the historical rhyme, not repetition, of past bear market analogs. 2008 global financial crisis is a case in point. Remember, I'm saying it's a rhyme, not a repetition, so we won't have exactly the same macro or technical shocks or patterns, but certainly there'll be a variation similar to what we saw then and in previous analogs. The one clear one, according to our research, is a 3-stage corrective phase, the fall rally followed by rest of fall, and that is what we saw then and is what we're seeing now, with the capitulation still ahead, not in a straight line, in a zigzag behavioral fractal pattern, but certainly something that typically happens at this stage of the market. The capitulation phase is still ahead, again, just to repeat, from Q2 second half of next year onwards. Now, this is all part of what I call a technical Minsky risk pattern. I shared this some time ago at a previous foundation study of cycles event, which has now been updated on the chart. It's based on the economist Hyman Minsky's late cycle bubble condition signal fueled by easy money and irrational exuberance. What I did is add a technical framework to that, and it shows an expanding volatility pattern marked by significant price swings and a throwover bull trap. Essentially what it means is there's a whole lot of volatility, but the price swings are so wild that it's not clear which direction the market will go. In the end, it looks like it will go up. Many people get long and leveraged aggressively. That's 0.5, and that's the throw of a signal. But as and when that happens, markets roll over from overbought, irrational conditions, which are fueled by easy money. Case in point where we are now. And 0.6 is the kiss of death when we get the rollover. Now, what's interesting is we got the rollover and a retest, and of course we're still have the risk to pushing down into the pre-pandemic gap at 3,400, 3,260. Now, final summary insights, the roadmap model, that's the framework that I shared with you, but of course you can build that on your own existing framework. Make sure it's a composite cycle measure looking at multiple time frames, and it's matched up with the market context. Remember the sell in May pattern, but the second half of it, which is the autumn fall crash pattern, which this year has led to a strong bear market rally that continues. That often leads to the best 6 months, which is where we are right now, from late October into April, but that will likely be more muted given that we're in that bear market phase. Keep in mind the portfolio in politics with the midterm best part of the US presidential election, which is further supported by the gridlock outcome. And then, of course, short-term risk on continues, but it's rolling over. And ultimately, we need to position for that long-term decline, likely from Q2, second half of 2023. Thank you, everyone. I hope that's been useful and insightful. Look forward to staying in touch with the Foundation Study of Cycles. Remember, we have an active schedule ahead for the year ahead. And if you would like to stay in touch with any questions or feedback, my email is ron.william@cycles.org. All the best for the new year. Thank you very much.